So we introduced yesterday that farmers face single risk, no? Production risk, market risk, financial credit risk, institutional risk, and we have a very brief look to analyze the single risk. So we start with the production risk. Production risk is, of course, risk associated to the losses of the quantity, because we know that a large number of risks would affect the overall production of agricultural commodity and crops. So these include non-extreme weather events, the little rainfall, hail, frost, low temperature, and less frequent but catastrophic weather events such as severe floods, droughts, hurricane, and so on. So, but we need also to consider in this environment, this section, also outbreak generated by pests and disease that could affect yields as can damage by animals, fire, wind. So human-induced problems such as death, fraud, and arson also are notable risk in terms of sowing, in terms of the production. So these risks are usually manifested at the farm level, but often they affect the entire supply chain by the risk transmission along the value chain. So production risk mostly are associated with yield reduction, but can also affect the quality of the product. So this is another important aspect if we consider how much important is today along the value chain to deliver a product with a high standard in terms of quality. Um, if we refer instead to market and price risk, so we know that we anticipated before, very short words, that market risk are related to the issue that affect price, quality, availability, and access, no, to necessary products and service. So price for inputs and outputs can be highly volatile, as we emphasized before, particularly in commodity market, because where both the local and global supply and demand conditions are constantly changing. And we know that these risks usually materialize at market level, but have backward linkage to the farms, thereby affecting many different stakeholders. Anyway, we point out before that today the volatility of the market for commodity prices, especially for commodity prices, is a very uh, big challenge for the economic resilience for farmers at a global scale. So if we look at the financial and credit risk, we know that very rapid change in the given scenario in which business takes place, such as unexpected changes in government or business regulation, macroeconomic environment, if we refer at the several conflicts around the world, political risk, trade restriction, and so on. Uh, all these aspects are all major enabling environment risks that can lead to financial losses for agricultural stakeholders, of course, but especially for farmers. These risks have systemic impacts on decision making. It could affect the productivity of the sector and, of course, of the markets. So, because incentive can change Now, this risk can result in change in yield, quantity, and quality, and can even lead to the disruption in the flow of goods, service, information, and finance. But we emphasized before this is an area where farmers need to have a very, very friendly no relationship with the financial sector, with the bank, because they need to invest in infrastructure in a way to tackle the new global scenario. Of course, institutional risk are mainly related in the changes in regulation policy, uh, the, the question related to uh, import-export tariff regimes and so on that, of course, are mainly affected by the international scenario in terms of politics, tariff, and war, and so on. Personal risk, of course, are mm, just about equal to the personal risk of all actors in the economic system, because farmers are human. So the personal risk could be identified in the life and well-being of people who work in the farms, but today is a very important task to consider also the question related to the labor condition, health-related risk linked to the farmer's activity and so on. So in this context, in this scenario that we depicted in the word spent also in the first uh, video, we conclude that the crop insurance is just one of the possible tool in the ex ante management. So we have a distinction between ex ante and the ex post strategy for farmers in a way to tackle risk that surround the overall farmer's activity. But we know that the crop insurance is just one of the possible tools in a way able to manage no uh, the three dimension of the risk box that we depicted before. We know that the main limits of for a private market for crop insurance will be identified in the asymmetric information, but we underline that the most important limits for a private market that in a way would justify the public intervention in these fields would be the systemic risk eventuality that is a very very big challenges for agriculture, private agricultural crop insurance. So we have of course several model of crop insurance. We have uh, insurance that insure individual yields. We have insurance around the world that have as a subject of the contract the farmer's revenue. We have insurance that look at the pests and disease and so on. So we have very, very different um, model of contract in crop insurance markets. So what behind the public intervention in risk management in agriculture? We already introduced the question related to systemic risk, so the eventuality that the insurance company uh, cannot no, diversify the portfolio risk when systemic risk such as frost, drought, or flood could affect at the same time a large share of the insurance portfolio. But we have also some other questions that we introduce that are related to the question linked to the farmers is unable to control the production factors. This is the only sector in the economic system that where the entrepreneur cannot manage and control the production factors. And the other question related to the temporal lag that no, we have among farmers sowing decision and biological cycle of the crops. That in this time lag, we could have weather extreme events, market crisis, pests, and so on. So this is the main reason that could justify the public intervention on the field of risk management in agriculture. Why do people buy insurance? Why do people buy extended warranty? So these questions are answered by actuarially fair insurance and look at the risk premium concept. What we intend for actuarially fair insurance. So this is the concept that introduced that insurance should guarantee the by the for the farmers in this case um, paying the premium. The farmers get a position where the premium is equal to the expected value of the payout. So an insurance is actually fair when the premium paid by the insured will be equal in terms of expected value of the payout. So we could understand better if we look at this very simple example where we assume that we purchased an hail insurance against hail. So we have $100,000 as expected revenue, and we have, looking at the past, 80% chance to lose 7,500,000 crop fail dollars. We consider an utility function. So we have 20% to have at the end of time, in sowing time, $100,000 and 80% to loss $75,000. So the actually fair insurance premium should warrant to the farmers $16,000. No, because this is just the application of the 18% to amount of possible loss. So if we didn't get insurance, we could have an expected utility that, considering the utility function that we introduced before, this kind, so 189.7 as expected utility. So this is the premium that farmers should pay to have the same level of utility with insurance and not insurance. So we know that we will that we have a look that in this case when farmers subscribe insurance, he have as at the end of uh, the lifetime that we have from sowing to crops and the harvest, the utility function of the farmers with insurance is higher than utility with not insurance subscription. So, in this term, we understand that paying a, paying a premium for insurance subscription would warrant to the farmers a higher level of the utility. Then farmers could be incentivized to subscribe uh, insurance contract because it would be a certain level of utility after subscription. The very question is insurance ever fair? But we know that insurance premium is not ever fair because rarely insurance premiums is actually fair because insurance company have to behave making profit, but we have also other factors that could amplify, the level of premium that are related to administration costs for the insurance company, the asymmetric information question that we distinguish in the moral hazard and adverse selection that push to ask for insurance company a higher level of premium, and of course the question of the systemic risk that of course negatively affect the level of the insurance premium. So what is the maximum amount that some farmers will pay above, the actual fair premiums? The maximum amount of the money that a risk averse person, in our case a risk averse farmers, will pay to avoid taking a risk. And this is strictly linked to the how farmers, or in general terms, how person are risk averse. So strictly depending from the assumption that we consider respect to the, the risk aversion of the utility function.